The left-hand side is a 5-minute chart over here, and this is a 30-second chart. So I have stripped this thing down here to opening range gaps and Asian session liquidity pools. All right. And now you can go back into looking at where we are in relationship to, you can see the new week opening gap is up here. It's also encapsulating the Friday regular trading hours settlement price. You can already see there's a lot of liquidity sitting under this block of price action. It's just looks kind of wonky. I like the idea of coming back down to Thursday's opening range gap low. If it were to do that and trade down below it, we have Thursday's Asian session sell side liquidity. We have some minor sell side, which we've already attacked that. The bodies have stayed above that. We wicked down through it. We have this level here. I'm watching, should we start to slide again lower, that consequent encroachment. And then we have the Asian session low. When you don't have any data, nothing coming out at 8:30, and the day is pretty much void of any kind of volatility injections, no real medium impact or high impact from the economic calendar, you want to aim for session highs and session lows. That means, what was the high and the low of London? What was the high and low of Asia? What was the PM session high and low of the previous trading day? And then what was the AM session high and low of that previous day's trading? All of those are relative to where you're at on the market, pre-market. Like right now, we're trading at 20,390 even. By going into your chart and annotating where the highs and lows are, what was London's high and low, or the overnight dealing range? If we're in a market protraction where it's really running in one direction, you don't grade that. But if there is a consolidation, if you grade it, you can anticipate exactly where during pre-market, where the next subsequent premium or discount array will form. And you can trade the pre-market session without even having to be there for the opening bell or do anything the rest of the day. And you don't need to do it just in these instances. If it becomes something you like, you can simply use previous session highs and lows. That means not the daily highs and lows. That's also included here, but session highs and lows. So we strip it down to London session, New York session AM, PM session in New York, then you have Asian session. Okay, so you have 4 opportunities per day to frame a trade setup. Now, this is not an invitation for you to go hog wild out there and try to trade every single one of these sessions, but you should tape read them. It will help you become a better and well-rounded technical trader. You'll be able to read price better because you have a lot more experience doing it. My go-to protocol is when there's no data, when there's nothing coming out at 8:30, what you're going to aim for is session highs and session lows. Again, do not think that this is the only thing you do just because there's no data that's being released at 8:30. It can be utilized in days that have economic data that has medium impact or high impact news events around at 8:30 or so. But it's my usual reach for, okay, well, I'm just going to simply look for the liquidity in the previous session. So what was the high and the low in London? We're already annotating the Thursday's Asian range low, which would be below that would be sell side. I have Wednesday's Asian session sell side liquidity pool annotated right here with these relative equal lows. If you look at that low right there, it's 810, and we don't care about anything over here because that's the low during Asia, and it's a relative equal low. If we were to lose ground this morning into the regular trading session, 9:30 going into 11 o'clock London close, if we were to trade lower than this low here, my focus would be here for the morning session. That means between 9:30 and 11 o'clock or so going into noon. I want to show you London's overnight dealing range, so that way you can frame it and you'll know what to do each session. And you can do this every single day and you'll never run out of setups. Even on high resistance liquidity run days, these reference points will be used. On low resistance liquidity run days, they are absolute bangers for just easy, low hanging fruit objectives, getting in, taking your profit right there and being content with that. It may continuously run beyond what you're aiming for, but in the beginning, doesn't that give you a really good probability of finding consistent setups that would reward your diligence about looking for something that repeats over and over again? 5 handles a day on S&P and 10 handles a day on NASDAQ as your first rung objective, and you grow to 15 handles to 20 handles in the NASDAQ to 10 to 15 handles in the ES. And once you get it for the day, then stop, then tape read the rest of the day, because you're going to be training yourself for discipline. And you're also looking for that one good setup that you trust based on the technicals, based on your bias, based on everything you have going on. And if you're trying to just press the button every time you feel an impulse to do so, you're not really following a model. The only way you fix that is by going in and looking for one good setup that has a plethora of things that around it support the idea that is likely to go there in that direction at that PD array you're trying to trade off of. Being diligent about forming that responsibility, that accountability in yourself, only looking for that one setup. The way you get there is simply knowing where are the likely candidates for the market to draw to. taking buy side liquidity and sell side liquidity out of the equation in terms of just nearby swing highs and lows, and then framing on which swing highs and swing lows. Which are they? Well, in London, we have to frame obviously the London time. So we have midnight, so that's true day, and then we have kill zone, which is 2 a.m., which ends at 5 a.m. Now, where's the liquidity in that time? That's the low of it here. So it can rebook back to that low, but I'm not interested in that. I want to know what is the low. So this is London session low, and then you can already see what's here, smooth highs. So we have relative equal highs, so this will be London session high. What you're doing is you're labeling your chart with these reference points for the basis of understanding where certain liquidity pools will be a factor. There's a short-term little high here, so we'll be resting above that, buy side liquidity. But in reference to and in deference to time, what's more salient for the morning session? Is it the London session highs here, or this one single little candlestick high, where there would be buy side above both this area here and these? But which one's more likely to be a draw on liquidity? Would it be simply interest only go back up to this high here and not even disrupt these smooth highs, or would it be, yes, this will be one minor objective to reach for, but we would like to see it want to accelerate through that area to get to this area here before they could take their stops out of the marketplace. We want to see the market gravitate back here aggressively. That further is the likelihood in pre-market because we have a gap. Now, it's slowly eroding the size of the gap. If it was opening down here, that would be a rather large gap. But it's narrowing that gap now as we get closer and closer to 930. So we have time. Is it likely to draw all the way up there to 20,494 and a quarter? Probabilities are rather small, but it can. In pre-market, when there's no data, I like to look at where we were for London. So if we were looking at trading in London, these are the reference points that session created its range. The highest high inside of London between 2 o'clock in the morning here and 5 a.m. when the London kill zone closes. The time that the algorithm will be looking for liquidity, looking for PD arrays, looking for a reason to move. All of that is encapsulated inside that time. This is the same thing for Forex. What is the usual protocol for a discount gap opening at 9:30? Meaning, if we open lower than previous day settlement, what's the previous day on Monday? It's last Friday, always. Unless Friday was a holiday and there was no trading, we would simply use previous day or previous week if it's a Monday. So in this case, since it's actually Monday, we refer back to Friday's regular trading hours, close, or settlement price. Let's play devil's advocate for a moment. And let's say the next tick is the opening price and it's 408. Okay, so 408 even. So I would annotate my chart at 408 even, 20,408.00. And that would be lower than that level up here. So that would be labeled as Monday's opening range gap low. Now, because it's opened lower, what is the bias? What's the bias for the next 30 minutes or the first 30 minutes at 9:30, 10 o'clock? It would be bullish, expecting a minimum of half of that gap's range to be traded to because there's a 70% likelihood of half the gap being traded to during the first 30 minutes of trading. If it were to do that, I'm not interested in just simply going back to the London lows. We've already worked those here. So if we can get back through the London low, what levels would be impactful? Well, obviously we have a short-term minor buy-side liquidity there. So you can annotate that with a very thin level that doesn't draw too much attention. Okay, so it's ghosted there. You can still see it, but it's not jumping off the charts. Your eye isn't looking at that and thinking, well, this is all there is to this move. These levels are bold because I want my students looking at this chart to see that as a much more impactful level to draw to, not to simply, let me come up here and knock out the stops on anyone that's short here. This is where the majority of the liquidity is. If anyone's short up here, this is where their stops trail to. Using that 408 level, hypothetically, say that was 20,408.00, say that was at 9:30, and that gap would be solidified as a discount gap. That means for the next 30 minutes from 9:30 to 10 o'clock, my bias would be bullish at the very minimum until 50% of that opening range gap is traded to. Okay, so hypothetically, let's say that is the other side of the range, or what would be quote unquote the 9:30 opening price. That means that this would be your first tick price at 9:30, and then you reference where you previously settled on Friday because it's Monday. So you would drop your fib on that level here and up to 494 and a quarter. So there's 50% of the opening range. If it was using 40, it ain't using 408 because it's not even 9:30 yet. So notice that we would have half the gap here. And if it was sitting here like this, would I be content with simply trying to be long up into that level there, knowing that there is London session highs right here that are smooth? So what would be the most likely scenario for ICT to be trading in that situation? I would be long, looking for a partial here, but more specifically aiming for a draw in above here. Because if it's going to go here and it's in close proximity to those relative relative equal highs, it's not likely to leave that there because we have a whole lot more, or half the other portion of that gap still to be traded to. It could go a full gap closure or 3/4 gap closure. By blending session highs and session lows in also incorporating the opening range gap when the gap is allowing that measure of importance, in this case, hypothetically using that 408.00 level, if it were the opening price. So it's building several things, not just one thing, several things to lean on in terms of a draw on liquidity. And you're using finite reference points. The highest high and the lowest low of London session, that's what it is, okay? It's not going to change. It can't hide it from you, okay? And the opening range gap, if there is one, and generally there is one, if we're opening lower, you know, until half that gap is filled during the first 30 minutes, I am looking for longs. I'm not looking to go short. I'm never, ever, ever going in there on the basis of simply just going, I'm going to go short because we opened lower. That's the worst thing in the world to do. That's what retail-minded traders do because they look at the relationship between yesterday's close to where we opened today. The professional perspective is, where do we close from today's opening? That's the challenge I put out for the people that make indicators. If you plot a cumulative line on the relationship between yesterday's close and today's open, and you plot that on a cumulative basis, you're going to see what retail perspective is. And if you plot it on the basis of today's opening price versus today's closing price, you're going to get the professional mindset because that's actual accumulation and distribution once the market has booked. When there's an opening price is always rough cut sentiment. That means it's meant to go out there and inspire or discourage traders that are less informed because they're mostly impulsive creatures. So they see, oh, we opened lower than yesterday's close or last week's close. So therefore they think it's weak. So therefore they want to chase it and they go short. And then what happens is the gap starts to close in. Even if it's just a half a gap, that's enough to wipe them out. Many times because you retail traders want to over leverage, just a quarter of the gap being traded to would stop you out and cause you to have a losing trade or losing day. It's real important to measure several factors relative to time and then what price levels in those periods are we concerned with. If we're looking at days that have high impact or medium impact news drivers, then obviously what I'm showing here still is applicable. It's even more likely to deliver faster runs. What's missing is the volatility injection because of the news not being available to us. We don't have a medium impact. We don't have a high impact news driver. Basically, right now where we're trading right now, your focus should be, are we going to take the buy side here? Or are we going to take the sell side there? That's the next move. Nothing else except for staying inside that range between this high and that low. There's nothing else you can do. There's nothing else to do. Either it stays in the range or it runs for the buy side or it runs for the sell side. So your question that needs to be answered is, do you know with any degree of confidence which one of those levels is going to be traded to? Now, as we get closer, if it stays in that range between this high and that low, you want to see it draw higher. Why would that be a factor? Because the gap aspect, because you're already lower than previous day's settlement Friday. So again, at 9:30, that starts that countdown for the next 30 minutes between 9:30 to 10 o'clock Eastern time. Your bias is bullish until 50% of that gap is closed. It doesn't mean it then becomes bearish. It just means that 70% of the time, that's what's usually unfolding. That's what's usually likely to be seen in price action. Now, does it mean that if it doesn't go up there and go to 50% of the opening range gap within the 30 minutes of 9:30 to 10 o'clock, then it ain't going to go there? No. I'm still going to look for that. I'm just saying for a immediate bias, something to look for in price action, something to study in the tape read, something to draw your focus to instead of just looking at the charts and not knowing what you're looking at or what you're looking for. It gives you immediate information. If we gap lower, okay, look for it to go higher, up to half the gap. And that could be your entire model. And you never need to do anything else. You never need to come back and watch any of my videos. You never need to worry about any of my live streams anymore, ever. That's my goal as a mentor. My interest right now, as we go into 9:30, okay, or shortly after 9:30, because we have the strong likelihood it's going to be a discount gap, that means we're opening lower than Friday's regular trading session hours. My interest is the London session highs. That's what I'd like to see. I'm saying to you that I think, based on what we have right now, if we start to sell off initially and say we take out this low, then I would look for it to change directions and come back and target the London session high, and that would be what I'm aiming for the morning session, and it started to sell off first. If we open at 9:30 and we're below these relative equal highs and we're below the London session low, then I would look for a modest, tiny little Judas swing lower, taking out whatever 1 minute short-term low that may form between where we're at right now and 9:30. I would look for something like that. It doesn't need to do that, but I prefer to see that. And then rally back up and then attack here And that would be building on the basis of drawing into that discount gap opening, which half that gap would be 70% likelihood. In my mind, I want to see that half of that gap filled. Half of the gap is whatever that 9:30 opening price is up to previous regular trading session hour close on Friday. Long story short, I'm looking for these levels to be cleared out this morning. That would be my trade for Caleb. I would tell him, focus on that, use any fair value gap, use the first presented fair value gap, try to frame a basis on that being your model for the morning. And if it wins, you be done with it. If you lose, you don't do it again. You sit still.